Hi everyone and welcome to the webinar. Thanks for joining us today. Today I'm joined by Arjan, who is the co-founder and CEO of Perenna Bank. He's previously held positions at BNP Paribas, RBC, Barclays, and has extensive experience in treasury, capital markets, and risk. Today we're going to have a bit of a discussion back and forth as a result of kind of the crisis that's been unfolding regarding Silicon Valley Bank and then subsequently Credit Suisse. It's become quite clear that the compliance and some of the regulatory requirements, both from a reporting and a risk management perspective, haven't quite been enough to keep these banks from running into trouble. While the banks themselves met the minimum requirements on paper, they still obviously suffered catastrophic consequences. With social media, digital banking, and a difficult economy, the consequences of issues with banks can be quite sudden and obviously fatal. This is an important lesson for all banks to learn. They must go above and beyond regulatory compliance to ensure that they are truly safe and sound for both their deposit holders and their shareholders. Compliance should be the bare minimum. While regulatory compliance is a necessary step, it's not enough to protect banks from the crisis. Banks need to look beyond the minimum requirements set out by the regulators for compliance and invest in more robust risk management practices. Risk management is key. A strong risk management framework can help banks identify risk and mitigate potential downsides before they turn into crises. This requires a proactive approach to risk rather than a reactive one. Transparency, as always, is crucial in order to build trust with both stakeholders, being customers and regulators and shareholders. Banks must be transparent about their risk management practices, which includes regular reporting disclosures required by all stakeholders involved. So to explore this a little bit further, Arjan, thanks for joining us.
You're very welcome.
To kick things off, let's start with the fundamental issues that have occurred here. So the events seem to have started from a lack of disclosure of information, whether board or to the regulators. Would an increase in regulatory reporting and requirements, such as frequency, alone help to prevent this going forward? Or is a more holistic approach looking at governance frameworks, technology, data, risk management, all required to kind of make this work?
Yeah. Well, first of all, I don't think that the problem actually started with reporting. I mean, the problem started with management assessing the risk and doing things that actually weren't appropriate. That is where it started. The reporting, obviously, and disclosure and compliance is there to make sure management doesn't do that. And then you check management frequently enough to make sure that they do what they're supposed to do. Taking off hedges to boost the earnings is not something that you should do. And not having a CRO for that long should be a red flag that regulators should be more sitting on top of you and check more frequently. So there's definitely improvement to do there, but it starts with management, and trust in management is very, very important, because the moment trust goes, a bank goes. I mean, any bank goes. Right? Deposit run, there's no bank that can withstand a deposit run.
Is there something more from that perspective when it comes to management that kind of needs to occur to start, I don't want to say controlling the way banks are managed or the way that their board's functional structure or the oversight structure is there, yeah. But is that potentially an area that needs a bit more of a fundamental review where you can kind of get a bit more disconnect happening between maybe incentives that are happening for those particular actors, yeah, versus what's then actually required to maintain a stable environment for the bank?
Yeah, absolutely. There should be, management should do the right things, and there should be checks and balances that you have in management with collective skill set, like the CRO being there, the management doing the right thing. And we have to remember, and as you mentioned before as well, that rules and regulation are generally behind the curve, always by definition, because the banks, particularly the smaller banks, they innovate, and the regulatory framework is not there to manage businesses that don't exist yet by definition. So management and the board, the oversight needs to make sure that the management, the risk framework actually applied is compliant, but also manages the actual risks in the business, which might not have been foreseen by the regulation. In this case, with respect to Silicon Valley Bank, etc., I think the risks are there. The risks are run on the bank and unrealized earnings, and you can't take your hedges off. That creates a hole in your solvency, and that's a big issue. So that was a foreseen risk. But banking this specific niche of the market obviously is what they should do. That's their niche. That's what they're good at.
Yeah, so you mentioned for a couple of times there about the absence of a CRO. Now, obviously, the CRO plays a critical role, and I've read an article the other day, or it's more of a post, talking about the most thankless job in banking, being the CRO. It's the job that you need, but nobody wants to do. Is the absence of being able to hire an appropriate CRO, is that perhaps something that collectively as an industry, banking needs to look at a little bit more in terms of how to identify or how to produce skilled CROs if it's a job that no one really wants?
Yeah, I agree with that. We need to incentivize CROs to come into the business. Part of that it's important because a CRO is a difficult job. They need to control risk, but at the same time, they need to allow the business to take risk, because without risk, there is no business. So to get that balance right, particularly in innovation, it's difficult, and we need more of those people, and they need to be, rightly remunerated, but also not overly governed, in the sense that sometimes regulations put too much emphasis on liability and that drives people away from the CRO roles, and that's not a good thing. So it has to be proper compliance and proper regulation for that job.
Yeah, I suppose there's been a bit of transformation in general in terms of risk roles over the last 10 years or so, where risk departments, instead of being the gatekeepers of yes no answers, started to act more as say business partners, somebody to explain the regulation to you and explain the risks, but ultimately the business decision lies with the business.
Yeah, and that's, I think, what's the right thing, it's the right movement, and I don't think the regulations really appreciate that yet and are really set up for that yet, and I think that's a change that needs to happen to regulation and compliance.
Yeah, I think that's probably a very valid point. So going forward then, what lessons can we learn from what's happened here, particularly with SVB and some of the other regional banks in the US that have gone under? Could more have been done to prevent this from happening, either from a risk management perspective in terms of the way the departments are structured and, as you mentioned before, how people are incentivized, versus, say, preparedness, in terms of buffer assets and structuring of balance sheets and things like that?
Yeah. It's very difficult because the regional banks, the smaller banks, and smaller banks like us, we fulfill this innovation role. We do the front end. We're not, we're dynamic generally. You need to take certain risks that are new, and you need to be prepared to take these risks. But if you take deposits, the run on the bank risk is real, and nobody can survive that, which means confidence and solvency is real. Strong management and governance is important. But we should not forget that technology has really played a transformational role in banking. Banking, run on the bank risk now happens overnight, where in the past you had to queue up at a branch. That risk means that your actual liability transformation, maturity transformation, I should say, that is the function of a bank, has to be, unfortunately, less than it was in the past. People can't say my deposits are actually 5 year, because in the past they were 5 year on average. No, deposits now can go overnight. Historical data is not a good indication of future behavior of people. Social media means information, bad information, right or wrong, true or false. You don't even know whether something is true or false. It can be completely false, but it still might create a run on the bank. And those things are very, very difficult to control, and that risk needs to be controlled by more liquidity buffers, absolutely, or by having a shorter asset liability mismatch from a term point of view. But I think that's the way that banking has to go. And banking has to transform itself. It has to be new. It has to be different than it has been in the past. And that change is going to be difficult because, change is always difficult, particularly for an industry like banking with huge organizations. Yeah,
you mentioned before about runs on banks. Traditionally, it's the crisis management solution to a run on a bank is you just shut the doors. that's your solution. People have to, like you said, they have to queue up at a branch. You can almost control the outflow slightly. Whereas in a digital age, people have access to money instantly and they just move it all in one hit. You don't have necessarily the same responses or the ability to use the same responses as what you had before. Because the bank run, the traditional bank run of removing cash from your bank, physical cash, is not what's going to collapse banks in the future.
No, I definitely don't think so. You can obviously stop withdrawings or from your current account on your phone, but that one really creates panic immediately and just makes the problem worse. You can't control it anymore.
Especially in the world of social media, right? That
Exactly.
news, the spread of that contagion risk is amplified tenfold to what it used to be.
Yeah, indeed. And I don't think the regulators and the regulations are set up for that yet. They're behind the curve.
Yeah, so when you talk regulations, there's getting into the detail of it. There's specifics in the LCR around internet-only accounts, but the reality is, okay, most accounts aren't internet-only, but you still have the same access that you always had. The stickiness of the customer is still next to non-existent if you have access to the internet.
Yeah, but it's sticky until it's not, right? Something is liquid until it's not. And that's the key thing. If you lived through the financial crisis, everything was fine until it was not, and then suddenly everything comes down. So we shouldn't be complacent about how quickly this can change. And the fact that something has been working for 100 years doesn't mean it's going to be working for the next 100 years.
Yeah, no, I completely agree on that. So if we look a little bit more specifically at SVB, so they had over 200 billion in deposits. Yet they weren't required to meet some of the regulatory hurdles that banks in Europe traditionally are required to, such as the LCR or the NSFR, because it was exempted because it was a small bank. Now, appreciably, 200 billion in a US bank sense is quite small. They were the 19th largest bank, but in a European sense, that's still quite a large bank.
Massive.
The small size metric or measurement perhaps needs a bit of addressing. But the PRA recently has released its consultation paper on, the strong and simple regime. Is there a potential knock-on from the recent events where the PRA may go back and look at that and go, maybe we need to rethink where we set our thresholds for who's able to kind of be exempted under simple and the strong and simple regime rather than kind of maybe fitting into a higher category?
Yeah, I think for the UK, it's all right. They're doing it right, I think. The US, I don't know it that well, obviously. Indeed, 200 billion is I'd love to have a 200 billion balance sheet. That'd be awesome. Yeah, exactly. But the PRA, the liquidity rules there, they look at the LCR, they look at the NSFR, but they have also the requirement to not rely on them, but do what is right for the business to cover the risks. So they really have a catch-all in the UK that makes sure that you cover the risks that are not foreseen by the regulation, which is good. So we don't need to be that descriptive, and we need more onus on management to control the risks in there, which requires a good risk management framework. It requires a CRO, it requires an independent board, and that just creates a control framework. I sometimes feel that fewer rules are better. Put more onus, put more responsibility on management. Too many rules means that there's a lot of rules management can hide behind, right? I've met the rules, so tick the box, so it's all fine. Yeah, not really, because that this was slightly different, right? So I think putting more onus on management, which gives them all more flexibility as well to develop the business and to do new types of businesses that we don't know yet, invent new type of businesses that are going forward using new technology that comes out the whole time is important. So I think the small and medium regime is not that different than we haven't seen the details, or I haven't seen the details yet, but than what we currently have. But I think they have the right balance in the UK, and it's important because we need to keep that trust up, right? Because no UK bank can avoid a run on the bank or survive one on the bank. Trust is very, very important. And I would add, trust also means that every asset should be par. If you write an asset tomorrow, you should be able to, if everything stays the same, to sell it a week later at par. And unfortunately, that's not the case in the UK. If you write mortgages, they're generally on the water the moment they've been written. It's like a car. You buy a car and it's devalued by 30%. That's not the right. We need to get something right in the UK to create that confidence of solvency that every asset on the balance sheet is priced, is priced the right way, is priced in a fair manner, and that's not how we currently have it in the UK, and that definitely needs to change.
Yeah, so when it comes to asset pricing in terms of things like mortgages or credit cards or overdraft facilities, is that something where that should become a regulatory oversight piece, or is that something more that should just be established as good sustainable business practice?
I don't think it needs structural change to the way the banks operate. That's not going to happen voluntarily. Let's be honest. Change is not happening voluntarily. There needs to be a driver, and that's a combination from the Bank of England departments, because there's so many of regulatory angles to that, but also government policies need to be set to drive the behavior of the private sector to where it's good for the consumers, because in the end that's what the government is there for, obviously, and that's what everybody is for the community. So we need rule changes to make sure that we get a better balance and that there's a fairer way of working. I mean, at the moment we have savers that subsidize borrowers. Is that fair and equitable? I wouldn't think so. We have people on the back book subsidizing the front book. That's also not fair. How do you change that? Cheap is not always good, right? Fair pricing is right. Cheap pricing, there's a catch somewhere, and the catch is definitely there for all of us to see. We just need to accept that and change, and that change is difficult. People will resist it. Institutions will resist it, but the government needs to be strong and do the right thing for consumers and the long term. Something that works in the new, digital era that we're going into.
Yeah, and it probably goes back to the old adage: if it looks too good to be true, it probably is.
Yeah, well, but in the UK, everybody has got too good to be true mortgages. You wonder what it is, and we can see people that we can see parts of the mortgage market that are now struggling and don't know what to do and are hurt by it. Well, people say, "Oh, we got no problem in the mortgage market." Well, we have a huge problem in the mortgage market. It's just not really been recognised or talked about.
Yeah, so you're referring to more like niche lending or elements of the market that are typically underserved because you don't have that necessarily that diversity in consumer options.
Yeah, absolutely. I mean, we have obviously, and Fitch just published a report where the UK was bottom of the top 10 peers, so to speak, from a mortgage market reporting, from efficiency, etc. And that's something we need to address. And the housing market is dislocated. The housing market is broken. We need to build more houses. We do, but we're not going to build more houses if there are no people that can afford to buy the houses, right? The whole problem is the reason why I believe the housing market is dislocated is because we don't have a mortgage market that currently functions properly to support the new way of how the market works, and particularly after the global financial crisis, and that needs reform.
Yeah. So when you talk about the market not necessarily providing appropriately for consumers, so what's the alternative? Is there an alternative banking model here? Because ultimately, there needs to be a way forward. I put it to you, what's the idea? How do we kind of move forward with something new? It might not work, but how do we find different ideas to kind of deal with this?
Yeah. Well, change is difficult, so we hope it works because we've started it, particularly with the mortgage market. And the aim is, because you have very long dated mortgages, you need to fund that with long dated capital. You hear constantly that the insurance companies and pension funds, they should be investing in the real economy to get growth back. Housing market is a big part of growth. And in other countries like Denmark, like the Netherlands, like France, etc., and US, you have the insurance companies and pension funds investing in the mortgage market through the covered bond market. And that is really a stabilizing factor on the mortgage market and on the housing market. The US house market is very much correlated to incomes. Affordability is controlled by market forces. Mortgages are priced fairly. That's not the case in the UK, and that has created this dislocation. So what we are doing is and in the UK, pension funds and insurance companies have got no exposure to the mortgage market, which is strange, because a mortgage is a liability, goes down from 100 to 0, and a pension is a pot that goes down from 100 to 0. It's a very good matching, stabilizing system to do that. And that's what we see in particularly Denmark, for example. And that's what we're here to do, which reduces, and we're not doing it with deposits, so there's no run on the bank risk. It's very systemically stable. So we're offering everybody and the entire market that we want to work together with an ability to reduce the asset liability mismatch they have, reduce the systemic risk that we have in the banks at the moment, by giving an alternative to financing very long dated assets, which mortgages are, in a very consumer friendly way where we protect them against shocks of interest rates going up, by introducing 30-year fixed rate mortgages, which is the norm in a lot of countries. But that change is not easy. We've started the process, and we hope that everybody starts seeing that this can really help, reduce inequality, help key workers, first-time buyers, etc., to own their home, and help people that are over 55 borrow in retirement for whatever purpose, either to retrofit their house or to free up money to top up their pensions, because we've all heard that pensions are not good, are not large enough to support people's income in retirement. That's another problem that we have systemically. We can all address this using a new type of banking system. Well, I say new, it's not new, it's new to the UK, but it's served Denmark very well for over 100 years, and Germany, and it's been stable, and it works well. So it's been proven to work, and it still is very efficient despite all the technology changes that we've had, because you can't have a run on the bank.
So that's obviously the asset liability mismatch, is a fundamental part of what kind of drove SVB's balance sheet structure to the way it was, ultimately leading to its demise. But then where does that leave deposit holders? Because obviously we're still going to want to park our money somewhere. Does that become just a holding bank that doesn't really structure things the same way? They're not doing lending on the other side?
So deposits and current accounts will all be there. So the money will sit there. I don't believe that, if assets have more than a 5-year legal maturity, it really becomes a risk of getting unrealized losses on your balance sheet. So that's a difficult one for banks to do, particularly at fixed rate, which is what consumers need. And that's why you see the SVR here, where the bank basically puts the refinancing risk all on the borrower, because they can set the rate at whatever the funding costs are going to be. If there is a run on the bank just raises the deposit rate very high, so they get new money in, and then charges the customers on the loans a lot more, and then they offset that. Good for the bank, but it's bad for consumers and bad for taxpayers in the end if too many people can't afford their mortgages, of course. So that structure needs to change, where I think banks need to use their deposits, and the more deposits they have, to actually start lending to the real economy, to businesses, shorter term loans, 5-year loans, or unsecured loans, using that shorter term assets to deploy their deposits instead of long dated mortgage assets. I think there is a natural balance sheet asset liability match that we need to look at, and not using short term deposits to fund 30-year assets. That's just not the right thing to do.
Yep. Now, obviously, the volume of current accounts versus, say, the volume of mortgages is relatively close. But I don't think necessarily, say, 5-year loans or even car financing at 10 or 7 is going to necessarily match the volume of deposits. Is there potentially a space there where we holistically start looking at more advanced, say, term deposit products where consumers can portion out their salary for longer periods? You go into an operational account, a current account, and you apportion a certain amount to a 1 month, 2 month, 3 month tenor, and start pushing the kind of tenors that you would need to increase the deposit base in a realistic contractual way, rather than I've modeled my behavioral stickiness.
Yeah, no, absolutely. You can, but that will also mean a change in behavior of consumers, because generally it's very difficult to get long-term deposits. Generally, there is a switch into investment style accounts for those funds. Unfortunately, and this is another big change that hopefully will happen, is that consumers in the UK with their savings, they either buy equity funds or they put it on cash. Why not buy bonds? Why don't they have access to a liquid bond market? So it's something that we're looking at developing, retail bonds. There are a lot of regulatory considerations, I should say. We don't know yet whether the barriers completely or whether we can go around them. We'll do our best, or whether we need changes for that. But sometimes there's over-regulations which stops individuals that's buying a bond. You can buy an equity, but buying a bond is deemed illiquid, so you can't buy a bond, which doesn't make any sense because the bond should be lower risk as long as you hold it to maturity. So there are things that we need to, iron out, but people should have the opportunity to buy a 5-year bond or to buy a 30-year bond as they buy an equity, and that gives you an alternative use for your funds that you don't need for operational purposes, your savings. You can put them to work in a different way. And that's something that I think a lot of people are also looking at, which is very closely linked to how do you manage your pension? Everybody now is increasingly moving to a defined contribution pension. People are looking, okay, what are you going to do with your money when you need to draw a pension? How are you going to invest that? What is the best portfolio mix to do, etc. All of that development is going on, and it's very exciting. That, to my view, is going to limit deposits. I can see deposits being worked harder in the future because of technology, and because people are becoming more active now with their deposits, which increase the run on the risk of a bank on the bank. Because if you don't pay the deposit as well, there's more incentive to go somewhere else. So there is definitely going to be an upward trend in deposit rates, I think.
Yeah, and when you talk about buying bonds, right? Obviously, the notional amount for a bond is really the issue there. But you've seen, I don't know if you've seen recently in the markets, certainly on the equity side, there's a lot of kind of newer trading platforms coming up, allowing you to buy partial equities. You can buy, a tenth of an equity if you want to go buy an Amazon share and you don't have enough money for a full share. You can apportion that out. So I suppose logically it makes sense to be able to do the same conceptually with a bond. Yeah.
Absolutely, you can do it. Bonds is probably easier because you can get very, very small denominations. And really, in Denmark, the bonds there are 1 krone cent denomination, so everybody can buy bonds for a tenner, right? That's something that we'd like to get in the UK as well. There are some £1 bonds, gilts outstanding, but again, regulation is not really easily set up to do that. And selling these bonds, there are some issues with that need to be ironed out. But you can also, and you do have a few companies already that fractionize, if that's the right word, a bond, like you do in equities, but someone is also doing it for several bonds, which I think is a good idea. You just need to trust it, and you need to get the liquidity. Generally, you can't access the mass savings market with that because of the structured nature of it. You buy a bond, you buy a fraction of it. So what happens if you want to sell and go out? And that's something that's always at someone's forefront of someone's mind, of course.
Well, ultimately, though, in 2023, that should really just be a technology problem. That's a platform you can buy and sell bonds on, and you liquidate as you need.
Ideally, technology and trust. But if you liquidate something, there needs to be someone else who buys it. Right.
Yeah.
And that is generally the point. You need to get that mechanism, a buyer and a seller, bring them together. You need to bring them together through technology. The buyers in the wholesale market, once you've put it into fractions, it needs to almost like defraction to be able to sell it to the big buyers. That's why it's much better if you can get bonds and also share splits to very small denominations, because then everybody is interested in buying the same instrument, and that's when you create that liquidity. If you have a retail separate from a wholesale market, you kind of miss the trick. You miss the access to make it one liquid pool.
Excellent. Well, that's time for us. Arjan, thank you very much for joining us on this webinar. It's a fantastic discussion. We started a little bit further abreast from where we started, but I think that's kind of naturally part of the discussion, right? There's Absolutely. An assessment of the impacts that happens on the existing banking structure, and then potentially ideas of where we go forwards and how we kind of evolve holistically as an industry.
Yeah, totally agree. And thank you for having me. It's
Excellent.
Going to be a fascinating time ahead.
It certainly will. Thank you very much.
Ciao.